So the Federal Reserve, particularly Jerome Powell, has made quite an announcement that is going to affect a lot of folks' ability to stay in their homes, earn paychecks, or even keep a job. And we're here at Vid Summit 2022 here in Los Angeles, California, LA. And last night, PFS on YT and I had an opportunity to meet and speak to some other great YouTube channel creators, Economic Ninja, Financial Prepper. We didn't talk to I allegedly, but we did see him, and hopefully we get a chance to talk to him today. And I plan to bring you guys some more financial updates from these conversations and others that we'll have while we're here. But first, I want to talk to you guys about the housing market, what Jerome Powell said, and ultimately how at least 1.2 million American jobs could be at risk as the Fed tries to tame inflation and also drive down housing affordability. Now, with that being said, this is kind of a double-edged sword because what good is housing affordability if people don't have jobs to qualify for mortgages or even have the financial means of paying for these homes? But there are far greater things at risk here, but let's go ahead and just jump right into this. So ultimately, there's a housing supply shortage and an affordability crisis, according to the government. We can all agree to that. We saw home values increase and skyrocket during the pandemic. Now we're starting to see them level off, taper off, and start to come back down. Now, what Jerome Powell said was that he expects a relatively modest increase in unemployment. But with a headline reading 1.2 million jobs being cut, I don't know if I would necessarily consider that a modest increase in unemployment. Now, in my opinion, the job market is about to tank. And I have mentioned this before. I've been warning you guys about this in previous videos. Hopefully you are preparing for this, but this is going to be a devastation for us all. We are all going to feel the effects of the economic shift that is happening right now. Consumer confidence is going to go into the toilet, or at least what's left of it is gone. And I mean, this is ultimately going to have a drastic negative consequence, in my opinion, on the holiday shopping season. Holiday shopping season is done. It's over. Although stores like Walmart are already rolling out, and Amazon are rolling out holiday shopping deals and items already. Number one, they have surplus inventory. They have an overstock from delayed shipments, from backups at the ports, from supply chain constraints that have finally worked themselves through. And this is actually last year's holiday inventory that they've been sitting on, and they need to move. They need to get rid of it. But with that being said, they're trying to start early. They're trying to capitalize on what they can because they know you can sense their fear and worry and concern, which is why they're rolling it out early, because they know that buyer demand is going to be down for these non-essentials. So on top of that, we still have FedEx possibly and potentially going on strike, with that causing a huge disruption in the shipping of these goods for the holiday season. But at the end of the day, it all boils back down to less money flowing through the economy, less consumer confidence and willingness to spend that money on these goods, and a reduction in revenue, ultimately a reduction in profit. And then we'll see some cutbacks from these companies as they try to stop the bleeding. Now, Jerome Powell said he's looking to cut 1.2 million jobs across America to drive home prices down. And what that means is, in my opinion, basically, is that if you can cut the jobs, then unfortunately, this is sad to say, if you can cut the jobs, people won't be able to afford their homes. If they can't afford their homes, they'll be forced to sell them. If they're forced to sell them, the other people who can't really afford homes are going to have to buy these homes for less. Those will be your only options for buyers, besides big investment, BlackRock, private equity, and things like that. But even those would come in at lower offers, all cash, more than likely, no contingencies. But those investors are not going to pay top dollar with the traditional retail buyer. So it will drive home prices down at the cost of the homeowners seeing the loss taken from these prices being driven down. With that being said, Jerome Powell also said he doesn't even know. This is all just a guess. And in my opinion, he'll probably push for more unemployment than the 1.2 million projected, as he just tries and it's trial and error. Basically, he's just going to try to see. He drove up interest rates to see what would happen. Not much. Now let's cut people's jobs so they don't have any money to spend and see what happens. That's what he's doing, in my opinion. You guys correct me if I'm wrong, or if you think I'm wrong. I'm open to the debate. And the question is, what can you do to prepare? What can we all do to prepare for this? But you guys stick around to the end. I'm going to tell you what I think about that and what I'm going to do to protect my family, my home, my assets, my livelihood. But Jerome Powell said, he's looking to reset the market, basically. Home prices went up through the roof, and between home prices going up, inflation, he thinks that this reset is going to bring inflation back down, although he said that inflation will remain high for some time, and there's already projections that the target interest rate or target inflation rate won't be reached until sometime in 2024, which we know is hugely optimistic and probably not going to happen, which means we're going to go through 2023 and into 2024 with relatively high inflation. While we are following the Fed's direction on, listen, pay attention. We're projected to have inflation for the next year or two, high inflation for the next year or two, while the Fed is also saying they're going to cut jobs. So much like I was telling you guys before in previous videos, prices are going up, paychecks are going down. The food shortages and insecurities are going to exist for the fact that people aren't going to be able to afford to eat. But now this is going far beyond that. This is going to housing. This is going to shelter. This is going to a direction where people are probably going to be forced into homelessness and or housing alternatives or shelter alternatives, like living in your car, full-time van life, becoming a nomad, doing stealth camping, things that the best you got without living outside, exposed to the elements, and still trying to keep a roof of some sort over your head and hopefully still have a job to go to. Now, the biggest ones at risk, more than likely, are the families that are trying to hold on as it is. And they're going to feel the most pain as they're going to be getting forced out. Think about it. These are typically described as middle-class income earners. These are the ones that are doing their best. They're working hard, probably working 60, 70, 80 hours a week, combined household incomes, paying bills, trying to get by, maybe have some kids in school, in college, paying some tuition, probably paying their own student loans off still themselves. And inflation's going up, prices are going up. They're trying to hold on. They may even have some investments in some short-term rentals, some investment properties. These are going to be the ones, if they're trying to hold on, they're trying to get by, they're trying to excel at this American dream. Probably don't have a ton of savings, or they're kind of skating, but they're on a good financial path, but they are kind of struggling, but they are working hard, and they're doing all they can. They're making all the right moves. They're trying to lower their debt. They're trying to wean off credit cards and things like that. But the economy continuously is beating down on them. And these are the ones where if they lose a job, if they see a reduction in income, they're going to be the ones at the greatest risk, as they're going to have to let go of these investment properties, these rental properties. They may have to let go of their primary residence and or downsize, which downsizing isn't what it used to be. Downsizing 4 or 5 years ago was moving out of a big house into a smaller house, a smaller footprint, lower price per square foot, lower principal balance, lower mortgage payment. Now, with the increase that we saw in real estate, downsizing is moving to a smaller home and paying the same or more money for it. And that's before we get to the increase in interest rates, which is coming up. But small investors with short-term rental properties like Airbnb, VRBO, Vacasa, all these, they're probably going to have to let them go, as they're not going to be able to hang on to them safely and effectively and maintain their cash position, maintain their finances, have a safety net, and be at risk of losing a job, or actually having lost a job and potentially not having rental income from these properties and carrying those costs of ownership, maintenance, insurance, etc., as the people who would typically utilize these short-term rental properties, these Airbnbs, these Verbos, these Vacasas, aren't using them anymore because they too are being hit by the Fed, high inflation, 1.2 million jobs being lost. They are feeling the pain too. So the consumer confidence in travel, in vacation, in non-essential spending, in disposable income is going to go down. Buyers looking to finance are coming, potentially into an opportunity of lower priced homes in comparison to the prices we have been seeing lately. But in comparison to the prices that we were seeing 2 or 3 years ago, these homes are still relatively more expensive than then. But we can potentially see some housing markets decrease in price depending on the markets. Great. The Fed is actually delivering on this promise or goal of affordable housing. Got it. Now, here's the kicker. Interest rates are through the roof. Interest rates are beyond, mortgage interest rates now are above 7%. And what that means is, sure, the home values are going to come down, quote unquote, be more affordable. But for the average buyer, the average finance buyer, the average home owner looking to get a mortgage and not pay cash for these properties, they're going to pay the same, if not more, every month for the property. The only difference is the seller is going to receive less money because the price is going to come down, while the interest rates drive the mortgage rates up, increasing the payment. So in theory, the banks get more money, which these mortgages are federally backed, so the Fed gets money. But the whole point of it is housing will become affordable in a sense as the listing prices and the closing sale prices will be reduced, but the sellers are going to be at a disadvantage, probably at a time where they are forced to sell because the Fed is striving for job loss and unemployment. They're going to be forced to sell, take less money. The buyer has an opportunity, but is still going to pay a premium and through the nose because of high interest rates. And the only real winner, neither one of them are actually going to win. So I'll just leave it at that. But the question is, what do you do? What do you do from here? What do you do moving forward? What can anybody do to prepare? Well, I'm going to tell you what I'm going to do. I'm going to continue to budget. I'm going to continue to work on my budget so that I'm trying to, with inflation, with prices going up on essentials, we're spending as little as possible, therefore retaining as much as possible, number one. Number two, I'm going to continuously try to earn more money through multiple different streams of income. Diversification is a safer play for me, in my opinion, so I am not at risk of losing one income source, which is all of my income sources. Therefore, I want to have multiple streams of income. I want to have a backup plan. And this is through the multiple streams of income. Those are backup plans, in addition to savings, in addition to investments, in addition to other cash flow producing assets, other side hustles, other income streams. A network of like-minded individuals, much like the folks we're meeting here at Vid Summit, who are continuously striving to improve and pay attention to the warning signs that we're seeing in the market and prepare ourselves for what could potentially be coming. I just watched, I think it was CNN, and they were doing a report about the now Category 4, almost Category 5 Hurricane Ian in Southwest Florida reaching 155-mile-an-hour winds. And they said that, yes, heed the warning of the evacuation, but hopefully it's unnecessary and you can come back when this is over and everything is relatively fine. But if you don't heed the warning and you stay and it is catastrophic, then you may not be able to recover from that. And that's what we're doing with the economic shift that I'm seeing, that I'm witnessing, that I've been telling you guys about for months. And every day I am further proven more and more correct on my theories and assumptions. And as I continue to pontificate on what could be, I'm just going to keep grinding. That's all I can say. I'm going to continue to invest and be ready to invest more as these prices come down. And, this is how wealth is built. And if there's a situation where home prices are coming down and interest rates are going up, I'm okay with that, which I told you guys before. If you don't have perfect credit, you shouldn't be looking to get a mortgage, because anything under a 740 means your interest rate's going to go up and you're already paying a premium now. But ideally, paying cash for real estate, or at least putting a large sum of cash down to reduce the principal balance, which ultimately reduces the amount of interest incurred from that APR rate on the mortgage, from the interest rate on the mortgage, is going to be financially prudent and intelligent for building wealth and getting a wedge deal, as Meet Kevin would call it, a wedge deal in real estate. So I want to continue to invest and be ready to invest so that when these opportunities present themselves, I can jump on them and use that and to create another cash flow producing asset, plain and simple. I'm going to continue to pay attention to what's going on in the market. I'm going to be ready to pivot, and I'm going to be flexible. I'm not going to be, hard, fast and stand, gotta have this, gotta have that. I'm going to continue to be flexible. If that flexibility means that I'm buying in a market that I hadn't considered before, but I see it as a sound investment, I'll go for it. If that flexibility means that, maybe we rent longer than we anticipated because we see the downward trend in real estate, the upward trend in interest rates, and the greater possibility of picking up a deal, possibly even seeing the rent prices reduced as landlords start to see a decline in interest of qualified renters. That's that flexibility that I'm willing to have and willing to accommodate for, a year or two or three, who knows, because I know where it could end up taking us based on what I'm seeing, based on what I've experienced in the past, and also based on a lot of the conversations that I'm having with some really smart, really intelligent folks in the financial and economic space, in banking, in mortgage brokers, in real estate, some economists, some analysts, some strategists. This is what's going on. Some very smart, not afraid to admit, smarter than me, wealthy individuals, some of which who have been through market crashes before and can relate and share information and possible projections based on previous history. History tends to repeat itself. We are here today. I want you guys to be prepared. Please pay attention. Jerome Powell and the Fed, they're not playing. Jobs are at risk. We're already seeing it in the news. I'm going to bring you guys some more updates on some of these, as well as an update of an email that I received from a subscriber, which I really do appreciate you emailing me. They left a comment about a situation that occurred to them with their bank, which is a similar story and warning that I was sharing with you guys in a previous video. And I replied to the comment and I actually said, hey, can you please email me some more information? My email is in the description. I think that worked out really well because of all the bots in the comments and the spam in the comments. So I just said, find my email in the description. The bots and the spam cannot manipulate my description. So they went there, they emailed me, and they shared some very shocking information about the warning and questioning by their bank as they were transferring funds out of their account, asking what are they doing with the money, and how often or how much more often were they planning on taking this money out as the banks are tightening up. We got high inflation. We got housing affordability crisis. We got a liquidity crisis with some of these banks and other industries. And banks are in fear of bank runs and people ultimately running. Think about it. People run out of, they lose their job. They're going to go to the banks to get their money out of savings. I don't want to start a whole nother video here, but these are things we need to talk about in the next video. So if you haven't, go ahead and subscribe to the channel and turn on notifications so you don't miss it. And I'll make sure to bring you guys that update as soon as possible. You guys take care. Be safe. I'll see you on the next one.